What's up everybody, I am Jaspreet Singh and layoffs have been hitting our economy hard. First we have the crypto layoffs because the crypto market has been getting smacked and this has been hurting the crypto companies, and so now they've been trying to cut their costs as fast as possible. Then you have all the more recent tech bubble companies which are struggling to find more cash, so they're trying to cut their costs while trying to raise their revenue so they can turn a profit. And then you have the spillover into all the non-tech companies because of the economic conditions, especially with things like mortgage companies, because mortgage companies are now making less loans because of the higher interest rates, and so now they're just laying people off. But it's a little bit different if you are a mortgage salesperson, because a lot of times these aren't layoffs. They're just not getting paid as a salesperson, so people are just leaving, and so you're seeing thousands of mortgage workers that are just leaving or kind of indirectly getting pushed out of their companies. So what's causing all these companies to struggle and now lay people off? Well, it ultimately comes down to the Federal Reserve Bank, because the Fed over the last couple of years has built this bubble through all of the cheap money, and now because this bubble has resulted in so much inflation and people are not able to afford their basic necessities, they're having to bust the bubble, which is now causing these companies to now cut their costs and raise their revenues as quick as possible. To really understand this, we got to take one step back and understand how the startup mentality works, because if you have a good product idea and you want to be the first one to get this product out there, well, you're going to have to move quickly. And there's two ways that you can go about doing this. You can do it the profitable way, or we can do it the unprofitable way. I'll call this UP. The profitable way means you create something. Let's just assume that you create a marker and you can sell this marker for $5, but it costs you $3 to make the marker. So that means you have a $2 margin, and now you're going to sell as many markers as you can, and then anytime you have this margin, you are going to reinvest this margin back into the company. So if you can make $1 million profit, well, out of this $1 million, you're going to save some money. You're going to invest most of the money back into the company, and then maybe you're going to pull some money out for yourself. So you're kind of limited to how fast you can grow. Sure, maybe you don't pay yourself any money and you save very little money, so it's a little bit riskier on your end, but you're trying to invest as much of this money back into the company as possible. That way now you can grow sustainably and grow bigger, because you want to be the first to market, and if you can be the first to market, people will love your markers and it'll be harder for a new company to come in and take your share. But the unprofitable way, which has been the mentality of a lot of startups, is okay, I make $2 per marker, but I want to grow as big as possible, as fast as possible. And sure, let's just assume that I have a $1 million profit in this case as well. Now what I'm going to do in this case is I'm going to take all $1 million, reinvest it back in the company. And then I'm going to go to investors, and then I'm going to raise another $1 million worth of debt and invest this money back into the company. And then I'm going to sell some ownership in my company, and I'm going to raise $2 million from a venture capital firm who now is going to own a piece of the company, and I'm going to invest this back into the company. So now, not only do I have all $1 million to invest, because I don't need any savings, because I have cash from my venture capital investors, I have cash from the bank, from this debt, but now I can invest $2, $3, $4 million into the company to grow much quicker, to grow much faster. In this instance, it is very unattractive for a company to have a profit, because if you have a profit, you have dead cash sitting in the bank that isn't doing anything. So in this case, these companies want to grow as big as possible, as fast as possible. You don't want to have a profit, and you want to grow quickly. Now, when you're trying to do that, what you're also going to do, because the goal isn't to make a profit, is you are going to lower your margins. Because now the goal isn't to make a profit. So forget making this $2 margin. The goal is now to grab market share. And so what you're going to do now is you might sell this marker, which costs you $3 to make, for $2.50. So your cost is $3. I wrote the dollar sign in the wrong spot. Your cost is $3, but you're selling it for $2.50. Now what you can do is, if somebody else, in this case, is selling a marker for $5 because their cost is $2.50, well, this person isn't going to be able to compete with you, because now you can undercut them. You can sell your marker for $2.50 at a loss here, and even if your cost is $3 here, this person now is not going to be able to compete, because even if they removed all of their margin and they sell their market for $3, they're still losing. They're not making any money, but they're still losing to you. And now you might say, why in the world would you want to sell your market at a loss? Because right now your goal is to get market share. Because now if you're doing this, you can put this company out of business. Because unless this company has something proprietary or something unique, you're not going to be able to compete on price. This is exactly what Uber did. They would go into new markets and they would sell rides at a loss. So if you went to a new country, you would go on Uber and Uber would lose money anytime somebody used the Uber app. Why? So people would stop using taxis because Uber was cheaper. Now, once you start using Uber, you're going to fall in love with it and you're not going to want to use a taxi anymore because it's so much more convenient. And that's when they can raise their prices for you. That way you pay more money, and maybe they even reduce the cost, the payment for a driver, because now you're hooked into the system. And so the goal is to keep doing this and grow, and then eventually, whenever you're ready, that's when you can start increasing your revenues by raising your prices and reducing your costs to hopefully one day become profitable. So this has been the model for unprofitable companies. And the thing that helps drive these types of unprofitable companies is what's going on in the economy with the Federal Reserve Bank, because the Fed ultimately controls interest rates. And interest rates, this is where it all ties together, will determine whether or not it's worthwhile for a venture capital investor or a bank to invest money here into an unprofitable company. Because when interest rates are very low, it doesn't make sense for a venture capital firm or a bank to just keep their cash somewhere or make very safe investments, because your safe investments, like your risk-free treasury bonds, which is what these banks and institutions are looking at, are paying you next to nothing. So if you take one of these low-risk investments, you get no returns. But if you can make more risky investments, you can make much bigger returns. Now, sure, some of these unprofitable companies might fail, but when the Fed is flooding the markets with cheap dollars, there's no better alternative. So this is what's been going on, where the Fed was cutting interest rates, and then that makes these investments more attractive, these unprofitable investments. So now the venture capital firms, the banks, the institutions are taking hundreds of millions, if not billions, if not hundreds of billions of dollars, and throwing them into these unprofitable companies, which created a massive bubble with these types of tech companies. The way any bubble bursts is you have a lot of cheap dollars, and then you have FOMO, where now you have a bunch of money going into investments which should not be getting that money, and then eventually the money runs out, and now people realize, oh my God, there are millions, if not billions of dollars in this investment, which is worthless, and then that causes the investment to fail, which causes panic, which causes more people to realize that their investments are bad, and this bubble actually started to burst back in 2018. I was making videos on this when it was happening, because in 2018, interest rates were going up, meaning it was more expensive to borrow money. And now you had venture capital firms and these institutions looking for profits. And that's when they started to realize that a lot of these tech bubble companies were not able to secure a profit. They were not able to cut their costs and raise their revenues fast enough. And so we were starting to see the economy slow down in 2018. So the bubble was starting to burst. And people were getting very worried about what that was going to mean. Were we going to go into a recession? But then in 2019, President Donald Trump at the time really put a lot of pressure on the Federal Reserve Bank to avoid a recession. So what did they do? Well, the Fed started cutting interest rates. This is before the pandemic. So now the Fed starts flooding the markets with more cheap dollars, because now you had this bubble, the air was starting to come out, but then the Fed turned on the fan and they started cutting interest rates, even though, if you remember, back in 2019, we kept hearing about how we were in the strongest economy of all time. If we were in the strongest economy of all time, why would we be cutting interest rates? You cut interest rates typically when you're in a recession as a way to boost and stimulate the economy, because it creates more inflation. So it's a way to stimulate a slowing economy. And we kept hearing that, hey, we're in the strongest economy of all time. Yet here at the same time, we have the Fed working to stimulate the economy. That's what I was talking about in 2019. And so now the Fed's cutting interest rates, and now the machine turns back on. More money is being injected into our economy. And now the venture capital firms, the institutions are saying, oh, now we can make even more risky investments because we can borrow hundreds of millions, if not billions of dollars for super cheap. Okay, and that's exactly what happened. So now more money starts going into these companies, and then comes 2020, which was when the economy shut down, and now everybody is spending time on their phones and their computers because no one's going to work and you're stuck in your house. And at the same time, the Fed also starts cutting plus quantitative easing. So now they're handing out money to corporations. They're handing out money to people. They're handing out money to businesses. Money is being printed out of thin air, being injected into the economy. And on top of that, they're cutting interest rates to the lowest amounts that we have ever seen. And now we have the biggest influx of cash into our economy ever in 2020. Now the bubble really starts to grow. And then what happens in 2020 and 2021, we saw a huge boom in these tech companies. So now these tech companies are saying, oh my God, our users have just doubled or tripled or quadrupled. So we need to go out and grow even faster. So now we had in 2021 this valuation boom because now companies are saying, well, here we were worth maybe $400 million based off of our revenues, based off of the number of users that we have. But here in 2021, we're worth $4 billion. So now companies went from raising 20, 30, $100 million to raising $1 billion because they're saying, look at how fast we have grown. This economy is not going to change. This pandemic economy where people are using our products are not going to change. And so we need to go raise money and grow as quick as possible, as fast as possible. So now companies are going to investors and they're raising money at these super high valuations, trying to grow even quicker. Now, in this valuation game, you have to keep growing your valuation if you want to keep raising more and more money, because now when you're at $4 billion, the goal is to grow your users, grow your revenues. That way now you can say that our company is worth $10 billion. That way you can raise more money without giving away all of your ownership in the company. Because in the beginning, you founders are going to have 100% of the company. And anytime you raise money, you're giving away a little bit of your ownership. You're giving away a little bit of your equity. That way you can raise more cash to grow even quicker. And then what happened was 22 came and inflation now finally started to become apparent because during this period, the Fed kept saying that money printing does not cause inflation. You don't have to worry about inflation. And then in 2022, inflation got so bad where now the Fed said, okay, we need to do something to fight inflation. So we started to see not quantitative easing, but quantitative tightening. We saw this start in June of 2022 where the Fed started selling off some of the balance sheet. And now we saw the Fed also increasing interest rates. So now it becomes more expensive to borrow money, which is the opposite of what happened here, because before your risk-free investments paid very little. But when interest rates go up, your risk-free investments start to go up as well. Like your interest rate on your savings accounts, well, most of them probably haven't grown that much, but they are starting to go up. Now, of course, your savings accounts are nowhere gonna compete with inflation. However, you are starting to see these interest rates go up. And so now you have these banks and these institutions making the same investment analysis before. They're saying, well, for one, you tech companies or whatever company it is, you're not seeing the same growth that you saw before because the high inflation has been pushing the economy into a slowdown. And so because of this economic slowdown, these companies are not seeing the same growth that they wanted to see. So on the growth side, it's lower. And from an investment perspective, we need a higher guaranteed return for us to justify investing in these companies. So now all of a sudden, the banks and the institutions and the venture capital firms are saying, we don't think you're worth the $10 billion that you say you're worth. We don't even think you're worth the $4 billion we paid you last year. We think you're only worth $1 billion. And so now these companies, which have very high costs, because remember, they're not profitable, are saying, oh no, we don't have the ability to make our payroll for another 3 months. We need more cash. And so how do you make more cash? Either you increase your revenues or you lower your costs, or both. And right now, companies are struggling increasing their revenues because of our economic slowdown, which is being caused by inflation. But we have this like recession on the horizon. So companies are struggling raising their revenues, which means they're only left with cutting their costs. And the most easy way to cut their costs is to cut some of their growth. And so companies are laying off people while also looking for external money. So you're seeing a lot of companies do this. There's called a down valuation. And this is happening pretty much across the tech sector right now, where companies are doing something similar. We raised money at a $4 billion valuation in 2021, but now we're trying to raise a couple $100 million at a $1 billion valuation, which means I am willing to sell my company at a discount compared to last year just because I need cash. What would incentivize somebody to do that? Well, you're going to be needing cash, because if you don't get this cash right now, then you're not going to be able to make a payroll in a couple of months. And if you can't make your payroll and the employees are not getting paid, well, you're not going to be in business much longer. So if you don't get this cash, then you're out of business. And this is what a lot of tech companies are facing right now. This is why you've been seeing layoffs across the board, because we had this massive bubble build up over the last number of years. 2018 was just when the bubble started losing air. It started building way before that, but it started losing air here. They started refilling it here, and then they started blowing it up in 2020. And now here we are in 2022, and now we're starting to pay the price, because now these companies have to find a way to find a profit. And if you can't find a profit and you can't raise more money, well, then either you're going to close your doors, you're going to go out of business, or you're going to be acquired by another company, because they're going to say, you know what, nobody's willing to offer you $1 billion for your company. But what we'll do is we'll buy the entire company from you for $600 million. Take it or leave it. So it will give the opportunity for people to find these types of great deals, because now as interest rates continue to go up, you can bet that less and less people, less and less investors, less and less venture capital firms are going to be willing to make these same investments at these same valuations. So as interest rates go up, valuations go down, and that's very bad for these companies that are requiring these higher valuations to stay in business if you cannot sustain yourself through your own profits. So you're going to be seeing this massive craze, this massive rush of companies now trying to raise their revenues, which is hard in a recession, while also cutting their costs. And the most accessible way to cut costs is through these layoffs. And the concern now is, are these layoffs going to spill over into the rest of the economy? Because now when people get laid off, you're not going to have money to go out and buy a car. You're not going to have money to buy a home. You're not even going to have money to make your housing payments unless you can find another job. And so if our economy starts to slow down and it starts to spill over into other asset classes, well, this could be just the first piece of a domino that starts triggering more dominoes, which is why you want to pay attention to all the things that are happening here. If you enjoyed this video and you want to see which investments you should make when the market crashes, I made a video covering that, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. Uber, Instagram, WhatsApp, all of these companies were created during a recession.